Next, we talk about long-term assets. Okay, long-term assets, they have two common characteristics. They are acquired to produce or deliver products or provide services. In other words, the purpose is to generate revenues. If they are not intended to generate revenues, they will not be called long-term operating assets. Okay. For example, if you purchase building, it's not for generating revenues, and they are not long-term operating assets. And you can call them inventories, right? Or they could be your investment, but they're not your long-term operating or PP assets. And they are supposed to generate revenues for multiple periods. They only give you revenues for one period. That's not a long-term assets, right? They could be short-term assets like supplies. And for these assets, it could be tangible, okay, or intangibles. Intangible assets, they lack of physical substances. Okay, for example, trademark, patents, copyright, these are typical intangible assets. Regardless whether they're tangible or intangibles, they are both important long-term operating assets. Okay, and these long-term operating assets are reported on the balance sheet in their book values. Okay, so for Walmart, we have property, equipment, their historical cost less accumulated depreciation. I'm going to talk about that. So we're going to report a net amount of these long-term assets. We can call this book value. Alright, so let's talk about how we arrive those numbers. First, their cost are capitalized cost. Okay, everything we paid for those assets will be recorded at their historical cost, including purchase cost for sure, installation cost, tax, shipping, legal fees, preparations, calibrations, right? Everything will be included in the cost. Okay. But there's a limit. We can not means that we can put everything into the cost of the PP assets. What kind of cost can be added to PP assets? Okay. These are the capital expenditures. We call them capital expenditures. Can be added to cost of those PP assets. How to be a capital expenditure? The asset must be owned or controlled by the company. Okay, the asset must be expected to provide future benefit. Okay, that's very important. Right, if I spend a lot of money renting assets, okay, I cannot capitalize it because I do not own it or control it. Sometimes we have to repair our assets. Okay, however, those repairmen cannot provide future benefit, extra benefit. They can only maintain the current benefit, but they're not providing extra future benefit. So ordinary maintenance or repairmen cannot be capitalized. In other words, they do not add to the cost of those assets. Right, this is how we get these two lines, right? The historical cost of those PP assets. Then we'll talk about depreciation. This line. when we use those assets, when we use those PP assets, okay, to generate revenues, we're going to incur cost. Okay, these costs will be allocated systematically during the time period in which we use those assets, and we call it depreciation. For example, let's see this. First we acquire a truck for $80,000. Journal entry, we increase the asset truck, we reduce cash. That's easy to understand. Okay, and when we purchase, right, everything will be capitalized. $80,000 is a long-term operating asset or PP asset. Next, when we use this truck, okay, we can incur cost based on the allocation process. We allocated $12,000 cost for this year. So we're going to increase this depreciation expense account, cost account. We debit depreciation expense, and we are going to credit this contra asset account, accumulated depreciation account, contra asset account. Okay, a contra asset account on the balance sheet, it's going to reduce our cost of asset. So on the balance sheet, we're going to see this presentation. The historical cost is still $80,000, but we're going to report a contra asset account, which is a negative number, $12,000. So the truck, its book value, okay, which is cost less depreciation, accumulated depreciation, book value $68,000, and this is reported on the balance sheet. And the book value will remain, right, to be depreciated in future period. Now let's talk about how do we allocate the depreciation expense. There are many ways to allocate depreciation cost. Several factors we need to consider. First is a useful life. How long we're going to allocate, okay, the depreciation cost. Typically, the useful life will be much shorter than the physical life of an asset. For example, a vehicle you can drive for 20 years, but typically we're going to depreciate, okay? We're going to allocate cost for the depreciation for about 10 years or even less. The other is a residual value, right? These are the expected realizable value of the asset at the end of its useful life. For example, you have a vehicle. So by the end of the day, after 10 years use, you can sell the vehicles and you can get some remaining value. We call this salvage value. And the salvage value is not depreciable, okay? It will be taken away in the calculation of depreciation. Method. So how do we calculate depreciation? Typically, there are three common methods we use. We have the straight line method. So every year we take the same amount depreciation, or double declining balance method. This is also known as accelerated method, in which we book more depreciation expenses in early years and fewer depreciation expenses in later years. And third method is units of production method. The amount of depreciation depends on the usage of the assets. If we use the asset heavily, okay, in this year we record more depreciation expense. If we use the asset lightly, in the other year we book less depreciation expense. So let's talk about a calculation first under the straight line method, right? It's easier. So first we're going to determine the total depreciation base, which is the cost less residual value. Or residual value, we'll talk about that. This is a value we can realize when we sell the asset by the end of the day. So for this truck, our depreciation base is $72,000, and the useful year, we decided to allocate $72,000 in 5 years. Okay, in 5 years. So the annual depreciation, 72,000 divided by 5 is $14,400 annual depreciation expense. Or you can calculate the other way. We can calculate the annual depreciation rate, because we can use it for 5 years. The annual depreciation rate is 1/5, or 20%. 20% multiplied by the base is going to give us the same amount of annual depreciation. Journal entry. We've seen journal entry already. We debit depreciation expense $14,400 and a credit accumulated depreciation $14,400. Book value. Book value is the cost less accumulated depreciation. That is a book value we have for this truck by the end of the year 1. Okay, by the end of the year 2, what is the book value of this truck again? For year 2, we're going to have the same amount of depreciation, because this is a straight line depreciation. Okay, for year 2, right, the book value equals 65,600 less 14,400 again, or $51,200 remaining book value by the end of the year 2. By the end of the year 5, right, by the end of the 5th year, okay, if you do the calculation, the book value will equal its residual value, $8,000, meaning this truck is fully depreciated. An asset being fully depreciated does not mean it's useless. We can still use asset, but it's not going to give us any more cost, which is good, right? If the truck operates smoothly, we only have revenues, but without reporting any expenses. Double declining balance method. This is called accelerate method. The double declining balance method, as the name suggests, we're going to double the depreciation rate under the straight line method. Under the straight line, we just calculated 20%, and we're going to double that rate, making 40% depreciation rate. Also, the calculation is slightly different from the previous one. Okay, we start with not the base, we start with the cost, or the book value. The cost multiplied by 40%, 32,000, that's the first year depreciation, right? And remaining book value is cost, right, less accumulated depreciation, 32. Right, we can end up with $48,000 book value. Right, but be careful. For the second year calculation, we're going to start with the remaining book value. Okay, multiply by 80% again. Okay, it's going to give us 19,200. And the remaining book value will be lowered by this year's depreciation, because our accumulated depreciation now is larger. That's 40,000 plus 19,200. Together, that's my accumulated depreciation, right? And 80,000 less that number equals 20,800. Okay, we continue with this process with a new book value multiplied by the rate again. Okay, we're going to have this new book value. We do that for the 4th year. Okay, and for the 5th year, be careful. If we follow the same process, we can end up with a book value much lower than 8,000, which is the residual value of this truck. We cannot do that. Okay, so for the 5th year, the maximum amount we can depreciate is $2,368, which is going to give us remaining book value 8,000, which is also the residual values. So this is the maximum amount we may depreciate for the 5th year. It's very important. Right, if we compare these two methods, the straight line, double declining balance lines, you can see obviously it's accelerated, right? Accelerated for the double declining balance line, so a lot of depreciation early years. But for the straight line, it's even throughout the 5 years. Okay, selling long-term assets is going to give us either gain or losses, depends on the sale price and their remaining book value. Okay, if the sale price, right, is greater than remaining book value, we're going to have a gain. If the sale price is lower than remaining book value, we're going to have a loss. It's easy to understand. Right, for example, the company decided to sell this truck for $25,000 after 4 years of straight line depreciation. Right, so first we need to calculate what is remaining book value by the end of the 4th year. So let's go back to this table. By the end of the 4th year, under the straight line method, remaining book value will be $22,400. Okay, so if we sell it $25,000, obviously it's greater than the book value, and we're going to book $2,600 gain. Okay, these gains and losses are typically non-recurring components of income from continuing operations. Well, let's see some examples how we solve these problems in journal entries. Right, we have finished the calculations. So what we're going to do is to record a journal entry to show the sale of the truck and the gain recognition. So what we should do is we're going to remove the truck. Okay, we're going to remove the truck account, including its original cost and the accumulated depreciation from the books. So we're going to credit truck because truck has a debit balance. We're going to debit accumulated depreciation, okay, because it has a credit balance. So these two accounts has been removed. Okay, so I debit cash, the sales price, and then I credit the gain. Okay, finish the journal entry. This is typical how we record sales. If we have a loss, we debit loss. Okay, that's sales operating asset. And for all these PP assets, operating assets, we must also recognize losses if the assets is impaired. So what does it mean if assets impaired? Okay, when those assets cannot provide us with intended future benefit, okay, we say the assets is impaired. So how do we determine whether our PP assets is impaired? So we're going to calculate the sum of the expected future cash flows, undiscounted. if the sum of the expected future cash flows is less than the remaining book value of the asset, yes, we say the asset is impaired. Okay, we're gonna recognize a loss, impairment loss, if the sum of the expected future cash flow is greater than the remaining book value. Say no, there's no asset impairment, and we do nothing. So how to record a journal entry? Right, the impairment of asset is going to reduce, increase the loss, and then reduce the book value of PP assets. Okay, for example, for the truck, right? If we determine that it is impaired because maybe its parts has been broken, right? Something like that cannot provide intended benefit. We're gonna debit the loss, asset impairment loss, okay, and we're gonna reduce the book value of that truck. Okay, instead of reducing the cost of the truck, we're gonna increase its accumulated depreciation. Right, it's gonna reduce the book value of the truck, so we credit accumulated depreciation this truck. That's a journal entry to record. So asset write-down or asset impairment is a big topic in accounting, especially in practice, because if we insufficiently write down our assets, okay, we overstate value of our assets and we overstate our net income. And sometimes if we do that intentionally, that's accounting fraud. Or sometimes we can aggressively write down our assets. We call this big bash strategies. Okay, especially in the year of restructuring or in the year of management change. Typically this is going to happen. They're going to carry on these strategies to aggressively write down the existing book value of our PP assets, booking a huge loss. The benefit is obvious for the next few years. Okay, we're going to carry with lower expenses when we use those assets again, and our profit will goes up for the next few years. So what are the ratio related to PP assets? We have the PP assets turnover. This measures how efficiently we utilize our PP assets. Sales divided by average PP assets. Okay. Net amount, which is book value. The higher the better, right? Typically, those those ratio will be very stable. Okay, unless something unexpected happens. And comparing between these two companies, I would say that it's obvious for this period, a 3-year period, right? Colgate is more efficient in using their PP assets, which is evident by their higher PP assets turnover, and this ratio is also increasing. Okay. But this is also industry dependent. The high technology industries, right? It's much higher. And for the traditional capital intensive industries like airline industries, right, telecommunication industries, so typically will be lower. It's understandable. Alright, so next, another type of long-term operating assets is intangible assets. Right, they lack of physical substances. They are equally important. Basically, the two types of intangible assets, we have the separately transferable intangible assets, like all the intangible assets, patent, right? Trade names, all those can be separate, transferable. And there's another type of intangible assets that cannot be separated from assets, not transferable. It's called goodwill. Okay, goodwill is the excess of cost over the fair value of net assets acquired in a business combination. So we only can incur goodwill, intangible assets, if we acquire other people's business. Okay, when we acquire their business, and if we overpay, if we pay more than the fair value of their net assets. Okay, if we overpay, and the excess payment become goodwill. Why we call them goodwill? Because there's a reason to overpay, right? That means something must be good. Something will bring us future benefit. We call this goodwill. For example, the company or the business has a very good customer relationship, right? We're going to pay more to acquire them because the good customer relationship is going to bring us future benefit. We're going to record them as a goodwill. Accounting for intangible assets will be similar to accounting for tangible assets. Same thing, everything we paid for that, right, will be capitalized, recorded as a cost of the intangible asset. However, there's one exception: internally developed intangible asset, okay, are generally expensed as incurred. If we spend a lot of money doing research and developing our own product, R&D, okay, because it's internally generated. For example, you can apply for a patent, right? Everything is internally generated. These expenses will be reported as expense, as incurred. If we acquire other people's patent, okay, that's intangible assets. If we develop our own patent, okay, it's an expense. It doesn't mean we don't have the patent. We have the patent, but we don't record it on the balance sheet. Okay, we have the paperwork for sure. So what are the typical intangible asset patent? Right, it's exclusive right to produce a product or use of technologies to generate revenues. It's protected by the government. Right, it can prevent other companies from copying your idea or innovations. If we purchase a patent from another company, we're gonna debit patent. We're gonna capitalize patent, okay? And when we use the asset, okay, we're gonna record or allocate cost. We call this process amortization. But the basic idea is the same as depreciation, but we just use different term. We call it amortization. If we develop patent by ourselves internally, it's only an expense, R&D expense. Only legal costs and registration fees, okay, for successful patent defense, okay, in court, or successful patent registration will be capitalized. This is an exception for internally generated patent. Another intangibles will be copyright. The same thing, right? Copyright is granted by the government to protect their work for the exclusive use benefit. Typically, the period is the life of the creator plus 70 years. Okay, if we acquire somebody's copyright, we can record it as a intangible asset. Similarly, we have trademark. Trademark, it's registered names, right? Logo, design, image, slogans. If we purchase the trademark from another company, we're going to record its intangible assets. If we develop, okay, our own trademark by ourselves, it's an expense. Okay, it's an expense. Right, this is a famous trademark. Look at the price for this famous trademark, $35. $35 for the work. That's it. Okay, another intangible assets, franchise right. This is a contractual agreement that gives the right to operate a particular business in an area for a particular period of time. Like most of the fast food, right, restaurant will be a franchise, so you pay headquarters a fee, and they're going to allow you to open a restaurant under their name in a particular area for a particular period of time. Of course, they can help you set up the business, so that everything you pay for that will be a franchise, right? What's intangible, which is an intangible asset. Okay, and if it's an unlimited period of use franchise right, okay, you don't have to amortize it. Okay, if it's unlimited time, but for most franchise it's time limit. So when we have the intangible assets, a franchise right, it will be amortized. It will be amortized. Okay, amortization. Okay, we mentioned amortization for many times. It's similar to depreciation, and usually we only use the straight line method to calculate the amortization. So how does the company now account for digital assets such as Bitcoin? Now there's always debate about how we record a digital asset. Some people ask we recorded digital assets as an investment. Someone that consider recording digital assets as an intangible asset. But so far we don't have a current accounting rules for recording digital assets. But some companies like Tesla has reported digital assets as an intangible asset. But others, especially investment companies, report digital assets as an investment. Okay, and remember we have a unique intangible assets, which is goodwill. This is a excess of purchase price paid when you acquire some people's business, right? The extra price is goodwill. This type of intangible assets cannot be separated from the acquired companies. They cannot be sold separately, basically. Okay. They have indefinite life, so we don't have to amortize goodwill, but the goodwill intangible is subject to impairment. So we're going to check their values. If the value goes down, we book impairment loss. This is typically how we report goodwill. Okay, and sometimes this number will be huge, especially when companies grows by acquiring other business. We're going to see a huge amount of goodwill on their balance sheet. Okay, what is their analysis application for intangible assets? So this is tricky because there are hidden intangible assets because internally generated intangibles are expensed. So to get an idea how many intangible assets company may have, we have to go through their business, okay, carefully, because many of their patents could be internally generated and not shown on their balance sheet. Okay, if we do not consider those things, okay, our analysis may be distorted. Okay, and because of the intangible assets, comparison between companies may become more difficult. Okay, only the industry expertise can understand and make adjustment in order to make those companies more comparable.